the cherry picker or VIX new normal? Which one is it? This is Options Brew TV, and I'm Lex, your host.
I think we need to come clean. We have no idea what the cherry picker is.
I don't either. I made it up. I really don't. No. So what the cherry picker is it's a measure using like RSI and CCI and some stochastics to predict an overbought situation so that you could go short and take advantage of a downfall in the market. So I don't think it's necessarily a standard term, but I kind of like it.
They call it the cherry picker.
Yeah, I don't really use technical indicators very much for trading. I don't know. Some people do.
Indicators they go sour fast.
They do. You don't believe in them either?
No.
Have you ever used them?
Not fruit-based indicators. No.
Oh, well, I get the impression that they're sort of lagging indicators, which means it's already happened. And what good is that pointing forward? But maybe I could be totally wrong about that. People who use them are very much, all over it.
No, in all seriousness, I think actually that's a great point about like technical indicators, right? Is that they're describing what price has done in the past. Mm-hmm. Like they're kind of describing like the realized situation. But like I also know a lot of smart people that say because people pay attention to them, it's worth paying attention to them. Like, there's sort of that like, the reverse psychology, I guess, about them, that it's worth paying attention because other people are paying attention.
Yeah. Well, go ahead. Sorry, Jason. Go ahead.
No, I'm supposed to talk about this in my options summit, so you can ding the bell. My opinion on technical indicators. Yes, I've tried them and I've kind of like forayed into them, but my opinion on them is they're good trade planning tools. I think the people that are good at technical trading are really using it to help plan their trades better. Mm-hmm. And when it crosses this trend line, that my trade plan is activated, something like that.
Yeah.
And at times the best technical people, I think, are just catching data artifacts of something that really happens. There's a person I respect quite a bit who does time cycles. And they keeps talking about this 30-day cycle that happens in the middle of every month. And I keep telling them, you realize it's options expiration, right? Like you're picking up on something that exists, right? But things aren't happening. Where I think technical traders go wrong is they start attributing things that are happening because of the price, not because of something outside of their technical analysis.
Yeah, that's a good point for sure. So do you have a favorite technical indicator?
Me?
Yeah.
It's the cold open.
The cold open. I love the cold open.
Yeah, whatever Lex says at the cold open. And then Lex goes, give me green. And then all of a sudden the market goes green. I mean, that is my best indicator.
Let's talk a little bit about Lex's pick last week when the market was down 600 points. And I said, we're going to be up on the day. And we freaking snapped back rally. I pretended to buy the 3,600 SPX call for $1.20. And I went away for the rest of the day. I had some yard work to do and did some other things. I came back, there were $68 bid. That is a good trade.
It was a great
I think
trade.
you caught the 200-point SPX rally. We were like down 70, like you said, and we closed up like $1.20. And those 30 was it the 30? I thought it was a little higher than 3,600, but either way, yeah, it was like $70 bid almost by the end of the day.
Yeah, it's crazy. Yeah. I pretended to sell them at $3.
Yeah, you closed out half at $3,
and then $68 was the other half.
Which is a great trade to close out half, because when you closed out half, I think you sold them at $3. You've made money, and you've got 50% of your position still on for
right. So I'm locked in. I can't lose at that point, right? So I think it was like $90,000, and I had 120 in, and if I lose the balance of that, so I cut it. I had 60 left to lose, but I would make 30 if it went to zero. So I said, yeah, what the heck? I want to play for the long ball. I probably should have sold another 200-ish somewhere along the way, but I'm not that smart, and I'm total gambler in that thing.
Well, and that rip was sharp at the end of the day.
It was
right?
It was.
Yeah,
You could tell it was like it was a rip your face off. I love the rip your face off ones.
That's why you buy those nickels, right? Like,
I'm a big fan of nickels. Myself, I'm not a seller of nickels, and that's why I can't trade the other side of zero DTE, 0 days to expiration options. It's just too hard.
they're crazy. I mean, the prices, ever since you've did that trade, I've been looking more closely at some of these, but like that was a 2.5% out of the money option.
Yep.
I think it was like, what were we, like a single digit delta.
Right.
And it goes from $1 to 70. I mean, that's convexity for you. That's like the $10 word that everyone wants out of options. Like,
right.
It's long in that call.
Yeah. So yeah, and the other thing too is I forget what VIX is. This is our lead into VIX today. What VIX was, but VIX was forecasting 1.5% move, or is that, or maybe more actually. I just don't remember. Yeah,
more. I agree. Yeah,
I'm in kind of the range. I don't have to go all the way through the money to make money on that. It's just got to be enough fear to get people clamoring for the shorts, so that vol goes up in that option, or it's going to go up in all the options, right? So it was a luck play. Real quick comment. So someone commented just now on retail traders do in fact look at technicals and technical indicators, which I totally believe. And my point with that is I don't think it's a bad thing because retail traders are certainly at a strong disadvantage relative to the professionals when it comes to order flow, right? So retail traders have to have a reason to get long or short, and most of their trade ideas tend to be around direction, right? So they're retail traders, and we know this. They're not making bid-ask spread and accumulating edge in a portfolio. Their edge is having a very solid directional bias based on X, Y, and Z. Right? Would you agree with that, or is there something else going on?
No, I totally agree. Yeah, and the other thing too is retail traders are working with what they have. And while institutional traders have all the flow information that they need, retail traders, what they have is charts and price. So, like I said, sometimes I think that the best technical people use effectively these kind of data artifacts because they don't have the information that the professionals do. So, and I think it helps them structure their plans. And when flows go the other way to their technical indicators, they have that solid plan in place to mitigate any kind of losses.
Well, if you think about it too, someone could make the argument that looking at implied historical volatility in options, okay, which we have in TradeHawk, right? So we do show that. And it shows what it did in the past, implied volatility, right? So you can see highs and lows, and you can arrive at some mean value, and then you can get IV rank out of all this and that sort of thing. It's kind of a backwards looking thing. It doesn't necessarily predict what's going to happen in the future. Now, the argument against that is when implied volatility stretched in a particular stock or in the marketplace, the idea is that it's mean reverting, right? Implied volatility. So you make advantage of short vol, short vega when it's super stretch high, and the opposite when it's super stretch low, right? Doesn't mean that it's going to snap back right away. It just means that you're going to put yourself in an advantageous implied volatility or vega position, right? Relative to what you know about, the term structure of that volatility as well. Right. Any comments on that, Mark?
No, I think when we say retail, right? Like I think it's almost better to lump that broadly with like buy side, right? That there's not necessarily like there's retail, there's institutional, like they're all different types of participants. But like at the end of the day, there are people that make their edge from capturing the bid-ask flow, reading, the flows, like, managing those books of inventory. And then there are people that are buy side. And given the tools that are available to traders right now, whether it's the data, whether it's the alternative data, whether it's technical indicators, right? Like that's no different than buy side at an institutional place, right? Like they're all trying to get an edge out of the marketplace that's different than an edge from dealing those books, right? And it could be research. It could be, there's a lot of different ways to have a different edge than the person taking the other side of your flow.
Mm-hmm. Yeah. I think I made the mistake trading off floor post our adventure on the trading floors back when that happened, of trying to convert my on floor mentality to an off floor world. And it didn't work very well, obviously, right? It was totally ineffective. So, I had to come up with another strategy for actually hitting the buy or sell button, which I did too much. Our nature on the floor was we made money by trading a lot. Every trade we made was allegedly a positive edge trade, right? So having said that, there's a reason why the Vegas casinos have a lot of roulette tables, right? They have the edge. They're the market maker in that equation. I'm not trying to compare it to gambling at all. I'm not trying to draw that comparison. I'm just drawing a comparison of edge. So if you have that kind of edge, you want to do it as much as you can, right? And that's what we did as floor traders. We wanted to have as much activity in paper. They're hitting my bid, taking my offer. I get to manage the Greeks in between. So I'm trying to work with, today, some of these retail folks and come up with, really effective strategies that don't take advantage of the bid ask, because we can get away from that a little bit with stocks like Apple and Spiders and those sort of things that are virtually a penny wide, right? So totally helps the retail trader. Fees are much cheaper, if not zero in places, right? So you don't have that part of a lag on your trading. Now you have to come up with a strategy where you're disciplined and you remove emotion. So it's called automation. That's how you remove emotion, right?
No, systems are great for that. And I mean, I think there's so many edges in the marketplace, right, that are not just buying low or buying on the bid and selling on the offer, right? And there's a lot of edges that are capital constrained that the Citadels of the world aren't going to go against, that they have other fish to fry, right? Dealers want to focus on one thing, and that leaves other efficiencies, other inefficiencies all across the board that retail people can capture. Yep. And, well risk managed, whether it's with zero DTEs, there's so many different products. There's so many different ways to take an axe right now. You've just got to find the ones that are, no one else is going after, and you capture in a systematic way. I think everyone needs to find that for themselves, and it doesn't matter whether you're buy or sell side for that.
Yeah, right. So what do you think? What's your feeling? Sorry, Jason, go ahead.
No, I was about to say the way I look at it is that spread that you're giving to the market makers is the price of them accepting your offer, no questions asked, or your trade, no questions asked. If I have a thesis on something with Apple, and that the market maker on the other side could completely agree with my thesis, but he's required to take the opposite side of my trade, right? And that is what I think you're paying for when you're looking at the bid-ask spread. Mm-hmm. And then when you get to one-sided, that's when those spreads widen.
Right. Yep, no doubt. What's your feeling on how retail traders position themselves? And I'll get more specific. What I mean by that question is, do you think they try to take advantage of collecting theta, more shorts than longs, or are they trying to be, kind of what I tried to do in the pop back rally last week, just buying a direct?
I think as far as options go, and you guys probably know this better than me, but as far as options go, just from anecdotal, what I hear and what I see on Twitter and the ads that I get, I think most retail traders are trying to hit a 10-run home run by buying calls and puts. Okay. I do not frequently hear about retail. Dave Portnoy is not selling options. He's buying options and cursing at the screen. I mean, that I think is more what retail does than anything else. But okay. I mean, you guys probably, since you guys have seen those flows, you probably know more than me.
Yeah, go ahead, Mark. Sorry.
I would say that there are sort of two buckets of retail traders in that respect. That if you're trading an options only strategy, I agree that for the most part, like if you're walking into Pepsi stock and like just putting on an options play, or you're walking into, Boeing was one of Portnoy's favorites, right? Like, but like if you're walking into that, I agree. Most people are buying options. I mean, structurally, that's the easiest thing to do, right? Like selling options is a much higher level of sort of, options approval and everything. It's a little bit higher complexity if you're doing spreads or anything. So I think if you're doing an options only strategy, generally, I think people are net long. I think if people are doing it against their portfolio, though, like if they already have equities, if they're managing a position that they have in IBM or Spiders or whatever that might be, I think people are on the opposite side of that coin, that they're sellers, that they're covered call writers. I was on a webinar earlier this week with a gang of it wasn't exactly the Theta gang from Reddit, but it was, covered call income sellers and like people that just prefer those slow and steady dividend stocks. They write the calls for income. Like, I think it's still a very popular strategy when you combine it with equities, and naturally combining options with equities, I think leads to a short option strategy.
Right. I think you're right. I agree.
I do think though that that's executed more by institutions than it is by, I think there is a subsection of retail traders that do that, but I think it's mostly institutional, where they do that for you, like all these wheel strategies that we talked about a couple episodes ago. Yeah.
Okay. Let's shift directions real quick. Let's get to the VIX. So I think, Mark, you made an interesting comment pre-show about VIX is in backwardation. Was that correct? Is what you said?
Yeah, exactly. So, we've been sitting here chopping around quite a bit, and I started looking at the VIX term structure. And I think it's an interesting sort of like indicator overall on the space, right? Like, it's one of the most liquidly, that's not a word, most liquid traded, instruments out there. And so it's like a great perspective on, what people think about the perspective for future volatility and, the markets going forward, right?
Right.
So let's
real quick, the VIX, let's explain what that is, just for fun. That's a SIBO product. I think it's singularly listed, right? It's proprietary.
Correct. And the VIX itself is actually an index. So to be totally clear, the VIX is the implied volatility index that every single day is calculated based on a steady 30-day out, measure of the options prices in the SPX.
Okay.
And so, it's not just the at the money, there's a whole skew that they're looking at too. So it's not exact corollary for what at the money vol is. It does include some of that sort of like downside skewness, kurtosis that's implied in there, but we can generally think about it as the implied volatility.
Right.
The tradable products are the futures, and that's what we're looking at right here.
Okay. So there's options on the VIX at SIBO. There's futures that are used to hedge those options, which I think trade at the Merc, if I'm not mistaken. Maybe they don't.
That the CFE, SIBO has the futures exchange.
Oh, that's right. That's right. Okay.
The VIX futures.
So that's their hedge. And the important note here is that the VIX cash price is what everyone focuses on in the news, right? So that's the cash index price, right? But each expiration month has its own future attached to it. And the pro traders use that future price to tell where VIX really is. Is that safe to say?
Those VX futures settle based on the delivered vol of the SPX over that period.
Yes. Okay. So what I'm getting at is what we're going to look, I think, at is there is a term structure going out in time that is appended to these VIX futures, and it can be in one of two places. I guess maybe one of three places. It can be in contango, in backwardation. I don't know what flatness calls it, if there's such a thing, but let's just call it backwardation or contango. So I think what, Mark, you were suggesting is that they are in backwardation now. So let's go through both of them real quick, and then you explain what you're seeing here. How's that sound? Sure.
So, like most commodities, anything that has sort of a term structure, any futures contract that has multiple expirations, this sort of standard structure is a contango structure. And I think that's easier to think about if you think about commodities like oil or corn or, something that actually has like a physical settled product. But generally that contango exists. Contango being the back months are more expensive than the front months. The really simple mental model for that is it costs money to store those things over that time. Mm-hmm. So like generally future deliverables are going to be, more expensive than, currently today. The cost of delivering corn in 6 months is more expensive because you got to keep that corn somewhere. VIX in general isn't exactly a commodity the same way as some of those, but more often than not, we're in periods of contango where back month vol is more elevated than front month vol or spot vol, spot implied vol, because generally vol being a sort of mean reverting asset, that most of the time the next 30 days look pretty serene. It's only when things are sort of panicked that we're worried about the next 30 days. But over the long term, do we expect things to be choppy, at some point over the next, over a 30-day period in the next, 6, 12, 18 months?
Mm-hmm.
Sure. Like I think it typically ends up being that, medium level of expectation of long-term vol. So to end up in backwardation generally means short-term panic, where spot is above the long-term implied vol levels.
Yeah. So right now, we know what's been going on in the market, right? We have massive down days, massive up days, and it seems like there's no rhyme or reason when that occurs, right? A lot of news-driven events, especially around inflation and interest rates, and all those sort of things. So we have this front month spot looking very much like it should, right, relative to the size of the moves we have. Do you think that backwardation part of it is an indicator of what's to come? Does it mean that we're gonna subside here in 30, 60 days, or is there something? Not really.
I think, and I'll show a couple charts comparing how this term structure is changed over the past year. But in many ways, I think the most interesting salient point about what the term structure is telling us is not only are we in backwardation, but that tail, that 180, 240-day number keeps gumming up. And it's actually a relatively flat structure that we've been in for an extended period of time here. That, we're expecting this level of volatility to continue for the medium term is what these prices are saying. Okay. And we're not spiking like we did in 2008, right? Like we don't have these insane prints in the front month or like we did in March of 2020, right? But we have a high flat term structure for these VX futures.
Right. Yeah, interesting. Hey, Jason, do you trade any of this stuff in your fund or not really, the VIX?
I don't trade VIX in particular. However, I do use it because, when we're talking about Vanna, there are multiple ways to try to use implied volatility with Vanna. And sometimes I use the VIX kind of as a easily accessible way to measure that out on a total basis. As you said before, the VIX includes a certain amount of skew and stuff. So I use it as a measurement tool. I do not trade it because of its mean reverting nature.
Yep.
And it's very difficult to kind of have a thesis with any given time frame, unless you're actually trading like VX futures. You can kind of see it's tailing off there at 240 days. Maybe you might think that's a little cheap. So you could see using this term structure in order to structure like a calendar or something like that.
Got it. Okay.
It seems relatively cheap until I'm going to flip it to what it was a year ago when front month was 15. 30 seems cheap, like 240 days out, but a year ago, 15 was the front month. I mean, it's your paradigm has shifted.
Yeah. I was just saying that was not investment advice. I wasn't saying that that's cheap.
Thank goodness it wasn't investment advice. No, yeah. So Mark, I don't know if you were around as long relative to VIX 8. Do you remember those days?
Oh yeah, exactly. Like the VIX can, it moves all over the place. And I think that's what's sort of, interesting about this environment right now is that we have this high flat structure. We're not spiking, we're not panicking up over 80. Even during some of the GFC periods, even the backdated skew, was much lower. Here we're just, 2% moves a day are going to be what we have to expect over the next, year is what the market's telling us.
Wow. God, that's so good for an options trader. Oh my God. I love it. Right?
So you buying or selling 30, 31 VIX or whatever we're at exactly?
I'm not buying it. I can tell you, I didn't buy anything. I tried. That's the only way I figured out how to make money trading options on the floor was I had to sell something. Eventually, very hedged though. Very hedged.
Yeah, I always, I mean, the VIX as an implied volatility measure can also help you determine if things are, when the market comes down. I had like a tweet not long ago, I guess it's like a year ago now, about over VIXing and under VIXing. Remember that, Flex, right? We talked about that here. And, the VIX has a strong correlation to the spot price, the spot vol correlation. Mm-hmm. And you can see how one-sided trades are by seeing how deviated you are from that regression curve. So VIX is an extremely useful index, but I also kind of reject the financial news fear index label that it is given, because it makes things, it kind of, I don't know, it's not exactly accurate and makes people read it in the wrong ways.
Right. All right. Well, good. I'm gonna shut her down now. I just looked at the time. We didn't see what the market's doing today, did we? What the heck, Mark? How did we not do that?
That's not so.
Don't worry about it.
A little bit.
Yeah, the Dow's up 211 ish, Nasdaq up 69, S&P's up 16 ish. Just another up day. What do you think?
We're getting lulled into complacency. I know Jason has a little bit of a bull target from here, but not much. I think you see some resistance at 3,800. If I'm going to crib off your Twitter notes, and I don't disagree, right? Like I think we're going to be in a pretty washy space. Like, to throw it back to that VIX indicator, we're going to see some up days. We're going to see some sharp rallies. We're going to see some drops. So
we have a 3,800 sort of. Is that a long gamma cluster there for the dealers that they can start selling into it?
I believe they are short gamma. There was a lot of bought puts. I mean, if you look at where we were a month ago, because this is OPEX week, options expiration week, there were a lot of hedges put at 3,800. We started at 3,900, and we dropped since last options expiration. So now they're all in the money for customers. And my 3,800 target was because of not only the charm and Vanna flows, making those go closer to negative 100 delta, but also because people are going to be cashing those out and start hedging at lower deltas. Well, I guess you could say higher deltas because they're negative. Higher deltas in November. So that's going to create buying from dealers. And I gave that thesis out on Friday, and we were down, that was not too long after the somber cold open. So that declared a victory, right?
Did you say the somber cold open?
Yeah, that was my indicator. I told you that's my technical indicator is the Lex cold open.
The Lex cold open. I'm going to give you another prediction. I'm going to give you another prediction next time. Not this time, though. I don't have one this time.
All right. But anyway, so I called it back then. We were going to rally up 200 points because of all those in the money puts from customers, and we've rallied up there. But my target has kind of been hit. So I'm going to start scaling back, and I'll start looking at November.
Nice. Okay. Good deal, guys. All right. Thanks. We'll see you next week, right? For another cold open. It's going to be on trading. All right. Happy trading.
Take it easy.